Hi, welcome to the Market Alert for Friday. Yes, it's Friday, the 24th of April 2019. So stocks inexplicably closed red after economy loses millions more jobs. Inexplicably. I don't think so. There was a report which we'll go into in just a moment. But let's just look at the jobless figures. You can see there now for the last 5 weeks, over 26 million jobs have been lost in the US. You can see the months before there where the job losses were minimal, and now we have this massive job losses every week in the millions. And it's not over by a long shot. I mean, as soon as they start to reopen the economy, the debts mount, the business are not patronised because people have fears of sitting by somebody else in a restaurant and etc. It's just going to get worse. It's as simple as that. It might taper off. You'll see a downward trend, but you are going to see millions and millions more lose their jobs. This is the reason the market moved lower after the jobless figures, which we'll look at in detail in just a moment. The stock dumped as Gilead crashes after FT reports Gilead's remdesivir flops in first clinical trials. This caused the Dow to drop 300 points in 1 second. And what else have we got? We've been printing more money. I forgot. US Congress passes a $480 billion bill, COVID bailout totaling a record near $3 trillion. They've done this in the last month. They've printed $3 trillion and are still in lockdown. Incredible. So let's have a look at the markets for yesterday. We'll start off with the daily chart. The market managed to move higher, and it was on the good, what was perceived as better than forecast job losses in the US. It's amazing how these markets can move higher on 4 million people losing their jobs and even 6 million losing their jobs that we've seen in the last few weeks. As I've said before, a total disconnect from reality. But the market did move higher yesterday, and it traded up to 62%, measured from this high to this low. So prices retraced. It went right to this point during yesterday's session, and now is heading to the downside. So I'm just going to put in a few markers for you where it's likely to come back down to. And let me just space all of this out so that we can actually see, and spread it that way as well. What you're looking for here, if it will come back, is a retracement through to the just move that over there to the 76% retracement. If it fails at this level and moves lower, then watch the recent low, because prices are likely to take this out as well. At the moment, finding support at 62% retracement from this high, making its way back. That's how it works. And what I'll do is just mark in this low. So watch this low. Prices break below 22,936, then we move lower in the bigger picture. So that takes care of the bigger picture. Let's have a look at what happened intraday during yesterday's session. So let's go into the pre-market session first. Is the electronic market before the cash market opens in New York. You can see prices closing above the 200 bar moving average, the 50 bar, the 20 bar, and also the close of the previous day. Prices start to move higher. And this is on the jobless figures. That's what the market moved higher on. And then as soon as the cash market opened, prices moved higher. There was some initial selling and offloading by those who want to get out of the market to close out some of their cash positions. But then the market found support, and we headed all the way up. And the market traded. That high is the high that you see here in the daily chart of 23,869. And then the market ran out of steam. We get the classic retracements here that you can see. Market moves lower, tries to move higher, fails to break the previous high, and then moves lower, and then you've got the same thing here, and then all of a sudden you get Gilead coming out and saying that the trials aren't working, and the market falls out of bed sharply and fails to recover. As you can see, the 200 bar moving average becoming a support for the market, but eventually failing with selling, as seen in the red bar, with prices moving lower into the close of trade there. So there's some weakness around in the market at the moment, as we've seen in the daily charts, and it's looking quite precarious actually. It's going to take a lot to move this market back to the upside. I know I said a couple of weeks ago in the market alert that we could move back to the all-time highs, but if the lockdowns remain in place at the moment, then we're going to get a pullback to the downside at this point, because there's nothing to move the market to the upside. And even if we do get a move to the upside now, it's going to be short-lived, because as the reality kicks in with the businesses closing down, some never opening, and as I say, people won't be spending, they won't be going to restaurants, pubs, clubs and all those types of places, and even travel, even to Vegas, that sort of thing. You can't believe the impact this is going to have. I don't know what it is with this sort of cognitive dissonance with people thinking that everything returns to normal when they say the lockdown has ended. The lockdown isn't going to end. It is going to be protracted, and it is going to be small baby steps to try and return things back to normal. And the longer this goes on, the greater the impact on the economy. It's not rocket science, it's just common sense and logic. The implied volatility, which we've not looked at for the last few days, remains in a sideways move. The option sellers pricing for risk is at 39% there at the moment. So that's about it. A quick rundown of everything there. And it continues. But for me, one other thing that we need to look at, which I haven't, is today's economic news. Oh, yesterday, by the way, the flash figures. Just have a quick look at those. Let me bring those up for you, because that was an interesting one as well. So let's just do this, and we have to go back, I think, just to pick those up. There we go. Yeah, so all of the PMIs yesterday were disastrous, as you can see there, both in Europe and in the UK, way below the figures that were forecast. But you'd expect that. So purchasing managers, a bit of a disaster there. The only interesting one was the US, but you can see there where the forecast was 35, came out at 36.9. That helped with these initial job claims as well, moving the market higher to that 62% level, and then failing. So there we go. That's it for this one and for this week. Have a great weekend. Enjoy the sunshine, and if there is anything to report, I will let you know. But otherwise, other than that, as ever, thanks for watching. See you in the next one.